QuickBooks Pro Desktop 2021. Bank feeds matching invoice to deposit. You want to get into it? Try QuickBooks. They're owned by Intuit. Here we are in our bank feeds test file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're now going to think about how the bank feeds can fit into a system where we're going to be creating an invoice and then basically waiting until that invoice is paid and clears the bank to match the bank feed that is cleared from the bank to the invoice. We talked about this a little bit with regards to the sales tax and a little bit with an overview in terms of how we would track inventory with it. Now we'll get into just a detailed example of creating an invoice and seeing it clearing and what will be the effect on the financials from doing that. So if we create an invoice, that's going to create an increase to accounts receivable. The other side's going to be going to sales. Typically, then we would receive the payment, record the receipt payment in our books, either put it into the checking account at that point or then record the deposit, put it into the checking account. If we did that full service process, then we would use the bank feeds to just double check what we have already recorded, the amount recorded in the bank account at that point in time. However, we might want to create an invoice and then simply wait till it clears the bank account. Possibly they pay us electronically or something like that. So it's easy enough for us to wait till it clears the bank account and then take that amount that was deposited, match it then to the invoice. If we do that, we need to make sure that the amount that's going to clear, the amount that's going to be going into the bank account will match the same amount of the invoice amount here. In other words, we don't want the deposits, the forms of payment that we're going to be receiving to have multiple different invoices attached to them because that will confuse the process. If we have one invoice that we're going to get paid possibly electronically through an electronic payment that will match that one invoice, then this is a system that could work and we could just basically wait till it clears the bank. Now, if you have sales tax involved in this, it'll kind of muddy up the system a little bit as well. And that would be if you're selling an inventory item with the invoice. If it's a service item, you won't have that added problem. But if you're selling inventory, then you might also have sales tax, and you might also you would need to think about how you're going to be tracking the inventory related to it as well. So one thing you can do is set up the item to make the invoice. So the invoice is going to be charged per item. Typically, you want to set up the item to make that easier, although it's not required to do so. So normally you would say, okay, I'm going to go up top. I'm going to go to the lists drop down. I'm going to set up an item here, and I'm just going to say a new item. I'm going to say I'm going to have a new item. So this is a new item. And then if it's a service item, you'll just charge it to a service item. You won't have to deal with sales tax, and then you can add the item in there. If it's going to be an inventory item, if you're tracking the sales tax within the system, you got to make it an inventory part. And then it'll use a perpetual inventory system to track inventory. We talked about that in the past. If you're not tracking inventory, but you want to charge sales tax, then typically you might want to use a non-inventory part as opposed to a service item, so that you can distinguish by items, service item non-taxable and non-inventory part taxable. And then you can use a periodic system to basically adjust your inventory. So I'm going to set this, I'm just going to call it item 5. This is going to be our inventory item 5 here. A generic name, obviously. And we're going to set the price. I'm going to set the price to be $183.92. And I'm going to say that this is a taxable item. The other side is going to be going to sales. So we're going to charge sales tax just to make it a little bit more complex of an item. So I'm going to then say, okay. And then if I go to my home page, let's say we're going to create an invoice for that item now. So I'm going to say invoice, and then I'm going to say customer 2. I'm just going to set up a new customer and quick add the customer. And then I'll set it up on, that's 520, that's fine. And I'm going to say now we have our item, which is going to be item 5. That's going to be the item we wanted. I'm going to say one of those, and then it will charge the item and the sales tax related to it. We set up the sales tax in a prior presentation if you want to think about or look into how to set up a sales tax if it's subject to you to do so. So now what's the invoice going to do? It's going to increase the accounts receivable by the 193.12, and then it's going to be increasing sales by the 183.92. And if we have sales tax applied, then the difference will be the sales tax, which will be a payable of the 920. If we're tracking inventory, it would also reduce the inventory and the other side going to cost of goods sold. Being on a perpetual inventory method, we're going to assume here that we're going to record our own inventory on a periodic method and not track inventory through the system. So I'm going to then say save and close and record this. And I'm going to say save it. And then let's take a look at our income statements and our financial statements. Let's look at the balance sheet first down here. Company and financial balance sheet standard. I'm going to go to the customized reports. I'm going to say this is from 01/01/20 to 12/31/20. Run that. And so we have then the accounts receivable should be going up. If I double click the accounts receivable for the amount of the 193.12, double clicking on that, there's our invoice for the full amount. The other side should be going to revenue. So I'm going to then go into the reports drop down, company and financial, take a look at the P&L, profit and loss, changing the dates from 01/01/20 to 12/31/20. And then we have sales that will be increasing by the 183, which is the sales price not including the sales tax. The difference then would be increase in the sales tax, closing these out back on the balance sheet, and it would be tracking the sales tax if that would be necessary for us to do, which we can then pay at a later time. So now what would happen is we're going to say, okay, on the home page, I'm just going to wait now until I get paid. I'm expecting to get paid possibly electronically. I'm just going to wait till it clears the bank, and instead of me selecting this item to record the payment, I just want to see it clear the bank and match it using the bank feeds. So I'm going to go to the bank feeds then up top and go to the bank feeds and the bank center. And then I'm going to be in this recognized item because it's saying it's recognized, but I'm going to imagine that we have a different thing, that it's not recognized, or it's not going to the same rule we set up before. Otherwise, it would be in unrecognized items. And then I'm going to say here, and sometimes it might be recognized if it matched it out properly. If it saw the match, it might recognize it. But this is going to a rule we set up before. I'm gonna say that this item then is going to be the one that's matched here. So I'm going to say, okay, I'm going to match that out. I'm going to hit the drop down, and I could go to match here. I'm going to go to more details, and then I'm going to go to the match side. And then here it is. Now here's the amount, 193.12, and it's matched to that 193.12. So I want to pick up that 193.12, and it should match it out. Now, when I have the bank account, this means it went through the bank. So that's a deposit to the bank. That means the checking account's going to go up. And the fact that I'm matching it to an invoice means the accounts receivable is going to go down, as well as the subledger for that account, for that customer. So I'm going to say save and close. And so that should then record it out. So then if I go back to the balance sheet, I'm going to say now the accounts receivable went back down, double clicking on the accounts receivable. There it is decreasing, double clicking on that item. Now note that although we took this from basically a deposit on the bank feeds, it didn't take us to a deposit form. It took us to a customer payment form. And the customer payment form is usually the form that we would record when we receive the payment. Also note that QuickBooks could have set it up to then hit the actual checking account at this point in time, but did not. Actually took it through we're taking it through the undeposited funds. So this is being recorded to undeposited funds, and then the deposit was made. In other words, if I close this back out and go to the home tab, we had the invoice, and then we received the deposit. And QuickBooks could have used the receive payment here to basically record the deposit directly, but instead they recorded the receive payment, made it go through undeposited funds, and then recorded the deposit. So let's take a look at what that means. If I go back to the balance sheet, then we had the accounts receivable went down. The other side, you could have gone directly to the bank account, but they took it to undeposited funds, which is not showing right here because it went back down to zero. I'm going to open up the trial balance so we can see it. Reports drop down, and accounting and taxes trial balance, changing the dates from 01/01/20 to 12/31/20. Here's the undeposited funds. It's back down to zero because it went in and out of it. So I'm going to double click on it. It's kind of like a clearing account. So there's the payment. So once again, there's the payment that went to undeposited funds, not into the checking account, which is where we saw it on the bank feeds. So there's that same form. And then at the same time, QuickBooks then recorded another transaction, which is the deposit. There's the actual deposit form, decrease in the undeposited funds. So there it is, decrease in the undeposited funds. The other side then going into the bank account, which would be on the balance sheet. So if I go to the balance sheet up top and go to the checking account, then we see the actual deposit for the $193.12, and going back into that, you see the actual deposit. So there we have it. Now, if I go back to the home page, so you'll note the process here. Like I said, QuickBooks could have just used the received payment to deposit directly into the account, but they didn't. They did the 2 steps when you matched it. So we matched the invoice directly to the deposit, which cleared the bank, and basically QuickBooks recorded it as invoice, increase in accounts receivable, the other side going to sale, then the received payment using the default undeposited funds account, increasing undeposited funds, and then decreasing the accounts receivable, then recorded a deposit, which increases the checking account, decreases the undeposited funds back down to 0 for that particular transaction at that point.